Hey there and welcome. Today, we're going to build your personal playbook for trading gold ETFs. We'll demystify the key strategies that work for everyone, from long-term investors to active day traders, so you can find the perfect approach for you.
So let's kick things off with a big question. You want the safety and stability that gold is famous for, but the whole idea of storing actual, physical gold bars, it feels a bit much, doesn't it? So how do you get that amazing benefit without any of the hassle?
Well, the answer is a gold ETF, or an exchange-traded fund. And at its core, it's a really simple idea. It's a fund you can buy and sell, just like a stock, and its value moves right along with the price of gold. This generally makes it way more stable than a lot of individual stocks, and it's incredibly flexible for both short-term trading and long-term investing.
Okay, so here's our game plan. First, we'll dive into strategies for the long-term investor. Then, we'll jump into the playbook for active traders. After that, and this is super important, we'll cover your essential safety net, the rules you just can't ignore. And finally, we'll look at how to mix and match all of this to create a strategy that's perfect for you.
All right, first up, the long-term investor. If you're the kind of person who loves a set-it-and-forget-it approach to building wealth, yeah, this section is for you.
So, our first strategy is the SIP, or Systematic Investment Plan. This one is absolutely perfect if you want to invest consistently, but without all the stress of watching the markets every single day.
And using a SIP is honestly super straightforward. You just invest a fixed amount of money every single month. But here's the real magic. When the price of gold is low, your investment automatically buys more units of the ETF. The key here, though, patience. The whole point is to hold for 3 to 5 years or even longer, and let that powerful averaging effect do its thing.
Just to make this a bit more real for you, let's look at a couple of popular examples from the Indian market. The Nippon India ETF Gold Bs and the HDFC Gold ETF. Now these are well-known options, often picked for their high trading volume, but they're really just a starting point to show you what's out there. Okay, on to our second long-term strategy, trend following. Now this one's a little more hands-on than a SIP, but the goal is huge, to capture those major market movements that can last for months or even years.
Okay, so how does this actually work? Let's break it down. First, you open up a daily or weekly price chart. Next, you're going to apply 2 indicators called exponential moving averages, or EMAs. Just think of them as smoothed out price lines. One reacts faster to recent prices, that's the 50, and one reacts slower, that's the 200. Your buy signal is simple. It's when that faster 50 EMA line crosses above the slower 200 EMA. And your sell signal? You guessed it, it's the exact opposite, when the 50 crosses back below the 200. And here's why this works so well. Gold has this habit of moving in these long, steady trends, partly because people flock to it as a safe haven when things get shaky in the economy. This strategy isn't about catching every little up and down. It's about spotting and riding one of those big, powerful trends that can lead to really strong returns over time. Okay, we've got the long-term folks covered. Now, let's switch gears and talk to all you hands-on investors out there. Welcome to the Active Traders Playbook. For all you active traders, a fantastic place to start is with the moving average crossover strategy. Now, that might sound familiar from what we just talked about, but the big difference is we're tweaking it for way faster, shorter-term trades. So the core principle is exactly the same, but your tools are going to change depending on your time frame. See, for short-term trades, you'll use a faster combination like the 20 and 50 EMAs to get quicker signals. But for those long-term trends we talked about, you stick with the slower 50 and 200 EMAs. It's the same logic, just applied at a different speed.
Now, these crossovers have some pretty cool names you really need to know. When the shorter-term average zips above the longer-term one, that's called a golden cross. And yep, that's your signal to buy. When it crosses below, that's a death cross. And that's your signal that it's probably time to sell or get out of your position.
All right, let's move on to our next active strategy. And this one is a true classic of technical analysis, trading with support and resistance.
The whole idea here is to look at the chart's history, right? You find the old price peaks, think of those as a ceiling or resistance, and the old price valleys, which are like a floor or support. The basic move? Buy when the price bounces off the floor and sell when it hits the ceiling. Simple, right? But what if it smashes right through that ceiling? That could be a breakout, and you want to see a big spike in trading volume to confirm it's the real deal.
But listen up, here's a massive pro tip for you. Gold ETFs can be famous for these fakeouts, where the price just pokes above that resistance level for a minute, only to crash right back down. To avoid getting caught in that trap, you always wait for confirmation. Look for a price candle that closes strong, way above that resistance line before you jump in.
Okay, we've talked about some really powerful strategies, but honestly, none of them matter without what's coming next. This is your essential safety net. These are the golden rules of trading.
I need you to really pay attention to this number, 2 to 3%. This is, without a doubt, the single most important rule in trading. Never, ever risk more than 2 to 3% of your total capital on one single trade. That is what keeps you in the game long enough to actually win.
And here are the other non-negotiables. You always use a stop loss to define your maximum risk before you even enter a trade. Avoid that emotional urge to overtrade. And remember, gold doesn't exist in a bubble. You've got to watch the US dollar index, because gold is priced in dollars. You have to monitor inflation and interest rates, because those directly affect whether people see gold as a safe haven. All these outside factors can totally change the game.
All right, let's bring this all together. In our final section, we're going to look at how you can build your very own custom strategy, mixing and matching these techniques to perfectly fit your style.
Think of this table as your personal cheat sheet. If you're into short-term trading, combining the moving average crossover with support and resistance, that's a killer combo. For swing trading over a few days or weeks, focus on those breakouts and make sure you see the volume to back it up. And for the long-term investor, you can run a SIP for that consistent investment, while using trend following to make your big strategic moves.
So here's the big takeaway from all of this. Gold ETFs really do offer genuine stability and safety. This isn't about getting rich overnight. It's about being patient, using a solid strategy, and making them a really strong, reliable part of your overall portfolio.
And that's a wrap on our Gold ETF trading playbook. We've laid out the strategies, the safety rules, the whole shebang. So now the question is, for you, with this playbook in your hands, what's going to be your first move?